All right. Hi, everybody, and welcome to the broadcast. My name is Clay Malcolm here at Advanta IRA, and today I'm delighted to be joined by Suja Shyam of Lux Capital. Hi, Suja. How are you today?
Hey, everybody. Great to be here. Thanks, Clay.
Yeah. And so we're going to be giving you some information today about some vocabulary that's really important when it comes to multifamily syndications and other types of syndications as well. And hopefully it'll help you with your kind of putting together your investment strategy and things like that. And Suja's also going to tell us a little bit about her journey in the multifamily space, which is a really interesting one. So, Suja, I really appreciate you joining us today.
So much, Clay. It's just really great to be here, and I'm excited to talk with you all today about the capital stack.
All right. All right. Well, so from a housekeeping standpoint, everybody, please do feel free to type your questions into the questions box on the console whenever they occur to you. We will take those at the end, but please feel free to type them in as they come to you. And if we've answered them during the presentation, then we'll just kind of skip over. But do feel free to ask questions about anything that doesn't make sense to you. I'm going to start out by talking a little bit about self-directed IRAs and how they can invest in syndications and things like that, so you have a sense of how that combination can work. And then Suja's going to take most of the presentation time to talk about the terminology in the capital stack and some other things about multifamily syndications, and then we'll take questions. So with that, I think I'm going to go ahead and start into the IRA part. So here we go. My short little disclaimer today, of course, is that all the information we're going to give you today is for education purposes only. We do not give tax, legal, or investment advice here at Advanta IRA. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to talk to your financial team and your tax team and your real estate team anytime that you're considering an investment for your IRA or for your personal funds for that matter. One of the things about self-directed IRAs is that the due diligence process does fall on the account holder. That doesn't mean you have to do it by yourself. Again, please do engage your team. But the decision about whether an investment is a good one or works for you in your financial world is really up to you. So we encourage you to understand your position in the equation there. And ours at Advanta IRA is actually very neutral. So like I said, we don't give tax, legal, or investment advice. Our job is really to just document the activity of the account so that it gets to keep the tax advantages of the account type in combination with the returns that you can get from a real estate investment that you may choose. And at its core, self-directed IRAs, really the terminology gets a little bit confusing sometimes because of the way people use it in the kind of investment space. But self-directed is really, it's a marketing term, it's a descriptive term. It's not an account type, it's not a legal distinction. And all it really means is that the account holder is going to have some sort of choice in terms of the way that the assets are allocated. So the account holder will make the investment decisions. That's what the self-directed part is. Now, at a self-directed IRA at a Schwab or a Fidelity or a bank or something like that is an IRA in which you probably choose between all publicly traded securities. So ETFs, stocks, mutual funds, things like that. Whereas a self-directed IRA at Advanta, we actually take the other approaches, which is that we handle all kinds of alternative assets. So all sorts of real estate assets, cryptocurrency, precious metals, private equity, private lending, all of those things that are considered to be private or alternative or hard assets. Those are the things that we service. So the account type stays the same, but the investment that you can access is a little bit different. So the equation that you're looking for is to have your IRA money at a custodian that handles the assets that you want to be in. So you can see a little bit of the information there about self-directed IRAs on this screen. And I want to dive into just why that could be important to you. So first of all, it can be for your savings for your retirement, right? Lots of times people have an expertise in real estate, or their team does, and sometimes that can lead to returns that you might not get in other investments. And so you can utilize that expertise, that private knowledge that you have, and combine it with the tax benefits of the account type. And of course, all the accounts that we're going to talk about today have the ability to compound faster in a lot of cases, in most cases, than your money would in a private or with your personal funds, because the earnings in IRAs are tax deferred. So the entire return comes back, and then it can be redeployed without having taxes taken from it. So it really is a very powerful tool. Time is your friend when it comes to these account types. And I will also say that if you've anywhere in your life, if you contributed to a 401k or an IRA or something like that, it becomes essentially your job as the account holder to get that money to make the most money, because you do have the tax advantages that are associated with the account type. So getting that money to perform is really taking best use of the account type. And then the other reason that this knowledge base about the idea that IRAs can be investors in private offerings, and specifically today we're talking about real estate syndications, but is the knowing that somebody, when you're talking to a person, you might be talking to actually two investors. It could be their personal money, or it could be their IRA money, or it could be both. And IRAs are a different legal and financial entity than all of our personal funds. So my personal funds and my IRA funds are a little bit at arm's length from one another. I control both of them, but the IRA has its own name, has its own bank account, because it has its own tax ID. It has its own tax ID number, and that's because it has its own tax advantages, different than my personal funds. And so anytime that I'm investing, I'm thinking about, okay, do I do this with my personal funds? Do I do it with my IRA funds? Do I want to invest both? And as I talk about this, I realize that I should just tell you, I've been a self-directed IRA investor myself for about 10 years. I've also been a self-directed IRA professional for a little over 11 years at this point. And so I really, I'm a person who's practicing this very technique. So I have a lot of empathy for what we all go through when we're choosing our investments and that kind of thing. So, but the idea here is that there's two real advantages. One is to combine the tax advantages of your account type with alternative assets, and the other is if you are raising money or looking for a partner for a deal that you have, understand that when you're talking to a person, it could be two different investors, so to speak, their personal funds and their IRA funds. And this is some of the, I guess the mindset of the IRS has to do with some of the way that IRAs operate, right? So I mentioned the fact that an IRA is a different legal and financial entity than your personal finances, and mostly that's because the IRS is going to give it different tax treatment. Now that also makes it so that the IRS wants to track that money, because they're only allowing a certain amount of money to take on these tax advantages. So that's the annual contribution limit for each different account type. So the deal that the IRS is giving us is, hey, we'll give you some tax advantages on some of this money if you do two things. One, you have to have a qualified custodian, and two, you have to follow some rules about how you invest. You can't invest in collectibles and life insurance, and there are a certain set of people called disqualified persons that you have to keep kind of at arm's length when it comes to certain interaction with your IRA cash and assets. So there's a proposition being made by these accounts from the IRS, and their mindset about it is part and parcel to the way that it operates. And the idea mostly is they're going to separate this money from your personal funds, put it in what is essentially a little trust that has a custodian. You get to operate those funds, but they are going to keep it a little bit separate because they want to make sure that the tax event is the appropriate one according to the account type whenever that occurs. Right, so the tax event with a traditional IRA typically occurs at the end of the life cycle, whereas the tax event on a Roth typically is at the beginning of the life cycle. So that changes, but the idea of this separation or arm's length of your tax advantaged account being a little different than your personal funds still stands. And again, today we're focusing on these real estate syndications, and an IRA can definitely invest in a real estate syndication. Oh, there we go. And so I mentioned the fact that self-directed is not actually an account type or a legal distinction. So the account types actually stay the same. So do understand that all we're talking about today is the difference between the money that you've contributed to these accounts purchasing a stock or a mutual fund instead of, or we're talking about it purchasing a participation in a real estate syndication instead of a stock or a mutual fund. Both of those investments could produce returns for your IRA with the tax advantages of the account. They're just different types of investment, and it depends. You have to have a custodian that knows how to handle a private investment. The account types stay the same, and we handle all of these. All of these can be quote unquote self-directed, and all of them can acquire a position in a real estate syndication or invest in all those things that we talked about earlier. So cryptocurrency, private equity, private lending, precious metals, et cetera, et cetera. The account types stay the same. Contribution rules are the same. Distribution rules are the same. Tax advantages are the same. The only thing that's different is what that money is going to invest in while it's in that tax advantaged umbrella. And when it comes to real estate, of course, we have a specific focus today, but do understand that if you have real estate expertise and you're in a number of different things, almost any of your real estate investment strategies are viable for your IRA. In fact, I often say to folks, if any way that you know how to make money outside of your IRA, more often than not, you can make money inside your IRA using that same expertise as long as you take the time to set it up properly. So almost all the assets that are available in the broader real estate asset class are available for your IRA. And I alluded to this earlier when we were talking about the disclaimer. I think one of the great advantages of self-directed IRAs is you get to bring your own team, your own financial team, your own real estate team, your own tax team. Whether that's your family or a CPA or an attorney, whoever that is, you get to bring that expertise and those people that you already know and trust and have them help you operate your self-directed IRA. I basically already talked about this in terms of an IRA being its own entity, but there are some technical things. So you'll see that an IRA does have its own name. It's separate from the account holder. So in this case, it'd be Advanta IRA FBO, account holder name and the account number. I did mention that IRAs have their own tax ID number. And when it comes to real estate and investments in general, I want to just make the cash flow cycle very clear. Your IRA has cash in it and its cash position. It disperses funds to acquire an asset. It pays for, in the case of real estate, sometimes it's purchase, maintenance, insurance, taxes. In the case of a syndication, it's usually a one-time disbursement, and there may be, let's say, a capital call later on, but that's not always the case. So the money comes from your IRA's cash position. It goes out to the investment. It is performing there, and all the investment returns come right back into your IRA's cash position. And at that point, you decide what happens to it from there. You could reinvest it, take distribution if you're of the appropriate age or it's right for your financial world. You get to make the decision for what it does and how you're going to help that money to work from that part, that point going forward. And again, this is a little bit of the more generalized real estate, but do understand that, I talked about the fact that an IRA can own real estate as an owner of a physical piece of property. It can do that either with just cash or cash and debt. It can have partners. It can also be an investor in a partnership or an LLC or something like that is gathering investors that's going to go out and buy perhaps a more expensive or bigger asset. So there are different ways for an IRA to participate in real estate. And again, today we're going to talk about real estate syndications and learning a little bit more about the returns and the nomenclature that's used in that. And so understand that all these things are available for your IRA. And when you're doing your due diligence on any of these things, there's a myriad of ideas that you have to really think about when it comes to doing your due diligence. And this is not a comprehensive list by any stretch of the imagination, right? So which market, the level of transparency, when it comes to a syndication, what's the experience of the syndicators, what's the timing of returns. Again, these are all things that you would use as perhaps indicators of whether this particular investment that you're thinking about works in your financial world, whether you are below 59.5 and you have kind of patient IRA money, or whether you're in a period where you're taking distributions. That can have a lot to do with what happens in terms of which assets you choose. But again, we encourage you to do the due diligence up to the level that you feel comfortable and utilize your team to do that. And I put this slide in most of my presentations just to give you a sense. I keep talking about the fact that having your IRA money positioned or your tax advantage money positioned at a custodian or in an account where it can access the investments that you want. And this is from the IRS website, and really it talks about the fact that you as an account holder often have some control, and often it's a lot of control over where your IRA money or your tax advantage money is. So all of this is about, can I move money without tax and without penalty to a different account type? And the reason that you might want to do that is because you might want to have it in a self-directed IRA that can invest in real estate. So this is not going to be a comprehensive kind of survey of this chart, but you can see there's a lot of yeses on there. So I encourage you to look into, take inventory of all the tax advantage money that you have and see if it can be moved into position. If it's not performing very well, see if it can be moved into position to perform better. And then here's the last slide for me, and then I'm going to turn it over to Suja for the bulk of the presentation. But a lot of people think that this process of setting up a self-directed IRA to invest in real estate or a real estate syndication is a very complex and time-consuming one, and it's really not. You can open your account with us. Usually, we get it open a business day. The account application just takes a few minutes. Typically, what you'll do is you'll open the IRA to give that, you have a new kind of account open, it's ready. So then you need to put some money in it. Typically, you'll do that with a transfer from another IRA, a rollover from an old 401k or other type of retirement plan, and or a contribution. Some combination of those three things, you will put money into the cash position of your new self-directed IRA. And then at that point, you're really out there looking for the investment that you want, negotiating those terms, letting us know about it so we can help you with the documentation. And when you say to deploy the money to close the deal, we do that. So it really is actually a relatively quick process. I would say that the fastest we can do it is a week, but I often see it take a week or 2 weeks or something like that. But usually we're talking about weeks and not months. So, and I'm happy to be a resource for you from today forward. So please do feel free to ask questions about this process. I went through a little quickly, but I really wanted to get to Suja's information, and I'm going to turn the screen over to her so that she can go ahead and hopefully put her screen on, and we will go for the rest of the presentation here. There she is, there's a screen. And Suja, are you with us?
Yes, I am here. Can you hear me okay?
I can, thank you. And so for everybody out there, Suja is the founder and CEO of Lux Capital. She has a special kind of expertise in underwriting, and she's been in this space for over 10 years. And so she's going to share a little bit about her own experience, as well as some of the vocabulary that we mentioned at the beginning about the capital stack and some of those things that some of us aren't as well versed in as Suja is. So Suja, I'm going to let you take it over.
All right, thanks so much, Clay, for the introduction, and really happy to be here with all of you folks who are clearly taking control of your retirement and your financial futures. It's just really exciting. It's a space that just energizes me so much, and it's why I do what I do, and really excited to be here. So let me just tell you a little bit about my story. I started in the real estate space in 2010, right after I graduated from my business school degree, and I knew that I loved real estate because I liked the intersection of community development, urban design, and real estate development. And I started out as an underwriter. So what that meant was I was working for institutional equity, meaning banks and financial institutions, and I was underwriting multifamily investments in the affordable housing space for them. So I was in charge of preparing the investment packages and making sure that the deal was going to pass muster with our investment committee. And our investors were other financial institutions, so pension funds, life insurance companies, other banks, et cetera. And so I kind of come from that institutional world, and that's my training, which is very conservative. If you think about how a bank would underwrite you if you were buying a home, they look very, very closely at your bank accounts and the property itself, and they take a very close look. So I was doing that for these institutions, looking at multifamilies. That was really great training, but I learned that I'm more entrepreneurial than that, and I didn't want to be at a large financial institution. I wanted to be on my own, set my own schedule, not have a cap on my income. And that led me eventually to becoming an entrepreneur. And I started out my entrepreneurial real estate career with short-term rentals. And that was a wonderful way to very quickly increase my cash flow so that I could replace my corporate salary and bonus, et cetera. So what that means is I basically set up Airbnbs. And believe it or not, I had a very small portfolio of Airbnbs, just 7 units, but that was enough to replace my income from my finance career, especially when you take into account all of the tax advantages of owning your own business, et cetera. So I replaced my income through basically Airbnbs. And then I decided, okay, I want to diversify my income, right? Because I knew all of it was coming from hospitality. This was like 2018. So we were well into the bull market that began after the Great Recession. And people knew, well, there's a correction that's coming. And I knew that as well. And I knew that hospitality was not considered a recession resilient asset class. I mean, of course, Airbnb is its own category and can adapt in a different way than hotels, as we've seen during the pandemic with many people doing work from home and at Airbnbs, et cetera. But in any case, I knew I wanted to diversify. And so that's when I kind of came back around to multifamily syndications. And I realized, after considering all the different things that you can do in real estate, there's a lot of different ways you can make money in real estate: wholesaling, flipping, small rental properties like duplexes, triplexes, et cetera. I realized that I wanted to play at a higher level. I didn't want to be so in the weeds. Not that you can't make money in any of those other things, but I just knew that with my background and with what I wanted in terms of a risk return ratio, that syndications are really my very favorite place to play in the real estate investing space. And why is that? So, like I said, I've had kind of a varied history in real estate. Like I've worked on the financial side. I have actually flipped a house. I have owned small rental properties. I have done Airbnb. And I have done development projects. I've built several of my own structures. And what I like about syndications, real estate syndications, particularly in the value add space, which is where you're buying an existing property and improving it along with a group of other people, is I like where that sits on the risk return graph. So, usually when you're investing in a syndication, I find that the returns that you can achieve are very attractive on a risk adjusted basis. So we're taking less risk and still getting these very attractive returns. Like oftentimes deals will project returns around, 16 to 20% average annual return. And so that's why I really like this space. So today we're going to talk about the capital stack and what that means. A lot of times people get a little bit confused about where the money comes from and what each pot of money is, where they sit in the priority standpoint, et cetera. So that's what we're going to talk about today. And, my role as an educator in this space is to help people really understand, because there's a lot of terminology, and like anything else, you've got to learn it before you can understand it, and then you can have fun with it. So we're going to talk about that. And let's see, I'm just going to skip ahead. Here's another piece of my story. One of the reasons why I didn't really want to be in corporate America anymore is because I frankly wanted to be in control of my own schedule. And so this is a picture of me just last summer rafting the Grand Canyon, which is a month-long trip. And, it's not something that I could easily do when I was working for a bank. And now with real estate investing, it's really freed up my schedule so that I can do what I want when I want. If I want to take a week to go visit my family and not have to even, I know a lot of people can work remote here, but now I get to set my own schedule. I don't necessarily have to work a full week if I don't want to. And, on the alternatives, like I can also go on longer trips and be off the grid and pass my business off to somebody who can take care of it while I'm gone. So this is a big why for me. Big part of my why is just that independence that real estate can offer you. And I know if all of you are here, you're thinking about that too on some level, whether it's with your retirement or with your life right now, or wanting to shorten your time frame, your time horizon to retirement. Or maybe go to part-time. There's so many different reasons to have options when it comes to your finances and different streams of income. So that's a big part of my why. And, since I started the syndication business, our first deal was in 2020. We've done about 8 or 10 deals since then. And we have just really grown tremendously. So we've got, self-storage, now we have multifamily, dozens of properties, large portfolio value. We've got over 250 plus verified investors. I'm really proud that I have over 40% repeat investors. And here's just some pictures from the last year. I've launched a podcast. It's called Passive Income Unlocked. Feel free to check it out. And here's just some other pictures of site visits, openings, due diligence. It's been an exciting couple of years and just really happy to be in this space. It energizes me, the types of people that I meet, the kinds of projects we get to work on, and the difference that we get to make in people's lives as they take control of their financial futures. Okay, so we're talking about the capital stack today. This is actually a fairly advanced topic. I've done a number of other types of master classes, and if you go to my website, which we'll talk about later, then there are a host of other topics that we'll talk about that you can access. So feel free to contact me afterwards if you want to, get some access to some of these different more rudimentary explanations of what real estate syndications are, because today we're going to kind of be jumping into some of the more advanced stuff. Okay, so now for the stack, the capital stack. What is it, why it's important, and how it impacts you as an investor? Before we get started, this is for your education only. We're not offering any sort of tax advice or legal advice. So make sure you check with your team about that. But let's dive into it. Okay, so let's start out with what is the capital stack and understanding. We'll start by understanding, we'll look at a single family home because that's probably something some of you are familiar with. The capital stack in a real estate deal is what are the pots of money that are needed in order to purchase a property, renovate a property, etc. So if you look on the right here, let's look at the first example, which is buying a home. Like if you're buying a home, you're going to get a mortgage, right? And let's just say that mortgage is 80%. So in this case, just as an example, $400,000 mortgage. And then as the homeowner, you'll put in $100,000. That's the down payment. The down payment is equal to the equity in the real estate deal. And so in this case, that's $100,000. So what does that mean really when you talk about debt versus equity? Well, if you think about it, when you're paying your mortgage, you've got a fixed rate. That's what it is in single family homes. You're usually getting a fixed rate loan for 30 years, maybe 15. So that's what the bank is going to stand to make. They're going to stand to make, let's just say it's 3%, 4% interest. They're going to make 4% and that's it for 30 years. Whereas as the homeowner, if the value of your property goes up, you're going to capture 100% of those gains. So if the value of the property goes up to $600,000, your $100,000 will turn into $200,000. So you've doubled your money, whereas the bank has a guaranteed position, but it's only 4% for every year for 30 years. So what's the trade-off, right? Like, how is that fair to the bank? They're putting in 400,000, right? Well, it's fair to the bank because they're taking on less risk than you are as the homeowner. For example, if the value of your property went down, as it, sometimes home values do go down. So if it went down from 500 to 450, well, the bank still owns $400,000 of your home, and you still have to pay them back $400,000. And now your equity is only equal to $50,000. So you would have lost $50,000. So you're in a riskier position than the bank is, because the bank can take back your property if you stop making payments, of course. You're in a riskier position, but you have more to gain, right? And so this is kind of the whole nature of how to understand these real estate transactions is when you're lower down on the priority stack, you're higher in your potential for making money. Okay, so now let's translate that to the right side and look at an apartment syndication. So I just switched the numbers here a little bit, and we multiplied by 10 because, bigger numbers. So let's say an apartment syndication, we're putting down 3.5 million, we're getting a loan, sorry, a mortgage for $3.5 million. And I say that because oftentimes we prefer to have a lower LTV, loan to value, 70%. We prefer not to be, I mean, sometimes you could be at 80%, but just so you know, my personal preference is to be closer to 70, maybe even 65% loan to value. And that's because we want to reduce our risk. We want to reduce the chances that the bank is going to take the apartment building back. Okay, so in this case, we've got a $3.5 million mortgage, and then the equity, which is equal to the LP capital. So let's say you want to take your IRA and invest in a syndication. You're going to put $50,000 into a pot of money along with a bunch of other people. And you guys together are going to add up to $1.5 million. That's the equity portion of the deal. So remember what we said about buying a home as the equity portion of the deal. You are at a greater risk than the mortgage is, the bank who's holding the mortgage, but you also have a lot more to gain, and that's the whole reason. That's obviously why we're in syndications, is because we want to make money, right? And we believe, at least I believe, that in most syndications, I mean, of course, you have to look at all the aspects of the deal, the sponsor, the market, the deal itself. But I believe that we're in a very solid position. If I'm investing in a deal, we're in a very solid position. So even though we are technically taking on more risk than the apartment, it's a position I feel comfortable in because I need to be growing my wealth. I need to be snowballing my wealth. And we've all seen those exponential growth curves. Got to start investing early to get that exponential growth working for you. Okay, so that's a very basic, this stack on the right side is a very basic stack. It's just got one equity position. However, it is possible to make it more complicated. So now we're going to break it down and talk about some other types, how that can be broken down. So in this chart, we're looking at an example where there's a senior debt position, which is the main mortgage, and then there's also mezzanine debt. So in this chart, we're looking at the highest priority to the lowest priority, and then if you see the risk is opposite of that. So the senior debt, which is in the highest priority position, you got to pay your lender first, right? Like you have to pay your mortgage first. You'd probably pay your mortgage before you brought your groceries, just because you don't want to lose your house, right? So that's the same with the senior debt in apartment building. They're the first to be paid from the cash flow that comes to the property. It's also possible to have mezzanine debt. They come second in the priority list. Now, mezzanine debt may come in the form of private debt. And in the case of mezzanine debt, because they are lower on the priority than the senior debt, they're going to get a higher interest rate. So senior debt might have an interest rate of 3%. Mezzanine debt might have interest rate of, let's just say 7% as an example. Next, there's equity. So, so for example, you might be offered in your investing career, you may see a real estate syndication where you're offered a position of providing private debt onto a property. And so that means that you might make 7%, right? Which is pretty good given where you are in the capital stack. So, as we're going through this, think about where you are in your investing life cycle. How much of a priority is it for you to preserve capital? How much is a priority for you to grow your capital? How much do you want income versus appreciation? And how much risk do you want to take? And things of that nature. So just know that when you're investing in real estate, there's not just one way to invest. You can invest with a more aggressive approach. You can invest with a more conservative approach, etc. So those are the two debt positions. And now we're going to talk about preferred equity and common equity. So equity, when we invest into real estate syndications, there's limited partners and there's general partners. Those are both equity positions. And so within that, you can have preferred equity and common equity. And what that basically means is that preferred equity gets paid first and the common equity gets paid next. And again, there's a trade-off there. There's usually more to be gained in the common equity position because they're lower on the priority. They're also higher on the risk, but they have more to gain. Okay, let's now talk about the waterfall. You may have heard this term, the waterfall, and how does that relate to the capital stack? So the capital stack is literally a stack. Like if you can see this stack that we've created: senior debt, mezzanine debt, preferred equity, common equity, and this is all equal to, I mean, a approximate percentage of, let's just imagine this is 25%, 10% for preferred equity, etc. So that's literally the stack. Okay, and then what is the waterfall? Well, the waterfall determines how each part of the capital stack gets paid out and when. So we've already talked about how the senior debt gets paid out first. And so they come actually before the waterfall takes into effect. So the waterfall is about distributable cash. So after all expenses of the property are paid, how do the partners get paid out? So the waterfall comes into effect after the senior debt and the mezzanine debt. So because, if the senior debt gets paid but the mezzanine debt doesn't get paid, then the mezzanine debt can actually take the property back in theory. And obviously no one wants that to happen, but that is kind of, the senior debt and the mezzanine debt are expenses to the property, whereas the equity positions, that's where the money is made, and that's where the waterfall comes into effect. So who, how, and when do the partners get paid? So one thing to point out here is that limited partners, like you as investors, when you invest into preferred equity or common equity, you are not loaning money to the general partner. You are investing alongside of us. So we're all partners and we're all here to make money and increase our financial position and shore up our finances, build passive income, etc. So we're partners and we're here to make money. Limited partners are not making a loan to the project. They are owners in the project. And so when we pay limited partners or you as investors out, it's not an expense to the property. We're all sharing in the profits, if that makes sense. Okay, so as an investor, you want to know where you stand in the capital stack, and you want to choose where you're going to be in the capital stack based on what priorities are important to you. Because you don't, like I said, you don't actually have to be in the equity position. You could potentially find a private debt offering and be there. Okay, so the waterfall comes into effect after the property has paid for its expenses, and those expenses being senior debt, taxes, insurance, maintenance, turnover, et cetera, all the operational costs that associate with property. Then there's profits, right? There's the profits that are left over. And so that's when the waterfall comes into effect. Okay, so why does this matter? So as an investor, the waterfall will impact your cash on cash return, which is the cash you'll receive during the life of the whole period. Usually we project these deals are held from 3 to 5 to 7 years, something around that nature in that time frame. And so you're going to be getting cash flows. So the waterfall is going to affect your cash on cash returns. It's also going to affect the IRR of your investment. And the IRR stands for internal rate of return. And it's a measure of the returns that you're getting over the life of the hold period. So over the entire life of the deal. So IRR is one of the best metrics to measure an investment because it takes into account the time value of money. So it takes into account not just how much money you get back from your investment, but when you get it back. So if you're higher in the capitals in the waterfall, then you are going to be getting your money back sooner. And you might not get as much money back as someone who's lower in the waterfall. And that's all going to affect the IRR, the internal rate of return. So you just want to understand that as you're looking at the different options you have to invest. And that's kind of related to velocity, right? Like as investors, we get really excited about velocity of capital. So how quickly can we get our capital back, get our returns back, and then invest it in something else? Because that's really going to supercharge our wealth curve. So all of that's affected by the waterfall. And now let's talk about a single tier stack. So we kind of went over some of the basics, but let's look at a single tier stack. So in this case, we've got senior debt, which is 70% LTV. And then we're going to go through some examples. So in this example, we've got senior debt LTV, and then we've got only common equity, which is split 70% to 30% after a 7% preferred return. So what does that look like? So there is a 7% preferred return. So after we pay the property expenses, the waterfall is going to look like this. Class A will get a 7% annualized preferred return. So this is kind of a blend, right? You're getting a preferred position within common equity because you're getting paid first as Class A. Then Class B is going to get all profits past the 7% until they're caught up to a 70-30 split of the cash flow. So now what about capital? So that's during the life of the whole period. Then once the deal is sold, we're going to repay any unreturned Class A capital to the Class A investors. So that's when you get your capital back, usually is on a refinance or upon sale of the property. We're also going to make up anything in arrears that's owed to the Class A investors because they have a preferred position of getting 7% preferred return. So if that hasn't been made up, if they've only gotten, maybe an average of 5% over the course of the whole period, then they're going to make up that preferred return. Then this is where you have to read the PPM and understand your particular deal flow, because deal structure, because sometimes there's a GP catch up. And what that means is that in this case, what that means is that after the Class A members have gotten their capital back and the 7% preferred return, the GP is going to get caught up till they get a total of 30% of the cash flow. And then after that, any remaining cash is going to be split 70-30 to Class A and 30% to Class B. And so the Class B partners, by the way, those would be the people who are running the deal, the general partners in this instance. And usually there's a split, could be 70-30, it could be 80-20, and it could even be 90-10, depending on how much work the GP is putting into the deal. Okay, so that's one question, and feel free to just put your questions into the chat, and we'll get to all of them when the presentation is over. Okay, so that was a single tier stack. Now let's look at a dual tier stack. So let's say you want to be in a slightly less risky position, but you're willing to give up some of the upside that you would get in this deal. So in this case, we've got senior debt still at 70% LTV, and then we've also got a preferred equity Class A. And then we've got the common equity after that. That's going to do the 70-30 split. So what would that look like in this case? So in this case, the preferred equity is going to have a 9% return, and it's just going to be straight 9%, and there's going to be no upside beyond that. In the first example, it was a 7%, but then the cash Class A investors were able to capture 70% of the returns of the upside after the GP was caught up. But in this case, if you want a preferred equity position, you're going to get 9%, and then you're going to capture nothing after that. So you get paid after the mortgage, and then you get paid 9%, and then the common equity gets paid. So according to the same thing. So what does that look like? Okay, so that's going to look like this. So let's just go over this first example. Class A is the preferred equity. Let's say they're going to put in $100,000. They're going to get $9,000 or 9% every single year for the 7-year hold period. Then they're going to get their capital back, and that's going to equal a total of $163,000. But they get paid first, right? They get paid before the common equity. So the projections show that common equity, Class B, is going to get a 4.4% return in year one. I mean, these are just projections, of course, and then a 7%, 7.8%, etc. So this is It's probably around a 7%, but what's going to happen with Class B is they're going to get, variable cash flow. But then at the end, they're going to, because of the 70-30 split, they're actually standing to more than double their money. So the total amount that they're getting at the end is 215,000 as opposed to 163,000. So they come second, but then they come second in the priority stack, but then they still have a lot more to gain. So this is kind of for every investor to decide. How important is it for you to get consistent returns and cash flow? And how important is it for you to be higher up in the water flow? Do you trust the sponsor? Do you believe enough in the deal that you're willing to sit in the common equity position? And of course, this is where the money is made, and I think a combination of being in Class A and Class B type positions is probably going to be useful to investors at various points, depending on where they are in their investing cycle. So that's pretty much how, that's like a basic overview of the waterfall and returns and understanding, how the money is going to come to you. So now I'm going to invite Clay to come back on and we'll do questions.
Unmute myself. Thank you so much, Suja. I appreciate that. And let's go ahead and get our contact info up there for people who want to contact us after the fact. But at this point, we'll open it up for questions. Happy to take those. So go ahead and type them in the questions box if you don't mind, and we will start taking them. So first question, Suja. When you said preferred LTV is at 65 to 70%, sometimes as low as 60%, are you speaking from the perspective of a limited partner equity provider, or is it that your personal preference based on your risk tolerance?
Yeah, that's a good question. So as an investor, I'm a passive investor first. I'm an underwriter, so I like to look at deals and decide what I think the overall risk tolerance is, or risk profile is. And I have personally decided that I prefer for deals to have LTVs that are less than 80%. I would maybe consider 75%, 60%, but I'm speaking from my company perspective and my investment thesis.
Okay. Next question. Can you elaborate a little more on the GP versus LP and what the financial benefit for each position is?
Yeah, great question. I might have skipped ahead there a little bit. So when you're looking at a real estate syndication, there are different responsibilities. The GP is also called the operator, is also called the sponsor, and the GP is the group that is going to be acquiring the deal, putting the capital stack together, signing on the loan, executing the business plan, and then selling the deal. And so the GP is basically running the whole project. The LP is the passive investor. So LPs, like you and like me sometimes, we just put our money in, and then we're what's also called as a silent partner. So we put our money in, we do our due diligence, we make sure we like the sponsor, the market, the deal. We're going to put our money in, and then we don't have control, actually. We just participate in the returns that the project is, but we also don't have liability. We certainly don't have responsibility for like tenants and toilets and other day-to-day responsibilities at the property. We don't have to sign on the loan. The sponsors, the GP, they are usually guaranteeing the loan, or they find somebody on their team that can guarantee the loan. So the LPs are the passive investors. The GPs are the ones running the deal. The GP is usually getting, somewhere around the 30% range. Although it could be 20%, it could be 10%, like I said. And then, one thing I didn't mention, but is that there can also be an IRR hurdle. So once a deal reaches an IRR hurdle, sometimes the split goes to 50-50 to the LP and the GP. So there you go.
Well, and so I guess this brings up a follow-up question I'll just ask if I'm a passive investor going out and looking at these offerings, is it really that are they going to be that different? And do I really need to know all all of the vocabulary to kind of discern what type of structure the particular deal is?
Yeah. So, you know, there are significant differences, and that's something that you will start to pick up on as an investor the more deals that you do, and it's you don't have to know everything all at once. The key thing is to find someone that you trust
Hmm.
and see how it goes with that deal. And you'll learn as you go along the way. Things will start clicking into place. And you don't have to necessarily understand all of it. You can let this information kind of just like sink in and it'll slowly start to make sense. But you do want to make sure that you're working with people that you trust.
Okay. Great. Thank you. Next question. Does a GP get paid a salary as an expense?
No, GPs do not get paid salaries. However, there are ways that the GP can make money during the deal that count as expenses to the property. So, and that's a good question. So GPs will usually take an acquisition fee of say 2%. And then that's one way that they can make some money before they're getting, proceeds from sale and cash flow, et cetera. Another way, so this is where the fees come in. And, I do have a whole presentation just on fees, but the GPs do need to keep the lights on. And so when you're looking at these deals, the main point is you want to make sure nobody's getting too rich too fast. We're all trying to make money together. We need to make sure our interests are aligned. And so understanding deal structure is really important to understanding alignment of interest. And it's another thing that you'll pick up over time. But for example, you would want to be careful if you saw an acquisition fee of 5%. In my opinion, that's something to look further into. Like a 2% acquisition fee, maybe a 3% acquisition fee is fairly standard for the industry. Another way the GP gets paid is through asset management fees. So they'll also take potentially 2% of rents coming in, and that's for managing the assets. And again, the idea is that they're not getting too rich too fast. And there's also sometimes there's a financing fee of like 1% of the loan amount, for example, for signing on the loan. Sometimes there's a disposition fee. And so there are ways that the GP gets paid. And it's not in the form of a salary, though. It's in the form of these various fees.
Interesting. Okay. Next question is, can you please explain the term equity multiple? And they proposed an example of what would a 2.5x equity multiple mean on a $100,000 LP investment?
Yeah, so equity multiple is a term that is useful for understanding your total returns over the life of the deal. So let's say it's a 5-year deal and you put in $100,000, then you'll get cash flow during the life of the deal during those 5 years, and then we'll sell the property, you'll get your $100,000 back, and then you'll get appreciation from sale. So if you add up all the cash flows plus the capital that you got back plus the appreciation from sale, that will equal 2.5 times $100,000. In this case, that'd be $250,000. So if you started with $100,000 as an investment, at the end of the deal, you would have received back a total of $250,000. And that's what a 2.5x equity multiple would mean in that case.
Okay. There's a next question is about evaluating GPs. So it's asked if there's a website or forum where we can evaluate the performance of GPs. How do I know if I'm working with a good one? And they go on to assume that the GP is not regulated by the SEC, which I'm assuming as well. So how do you propose to do due diligence on GPs? Is there a clearinghouse place for that, Suja?
Yeah, I mean, that's a great question. And it's one of the key things that you have to figure out as you're getting into the space, because these are private placements. And like you said, they're not regulated, but we're not although we do have to report and we do have to operate according to the law. So how do you find out? Well, it's actually somewhat time consuming to understand the performance of a GP and really get it. So networking, going to events, and talking to the GP themselves, talking to references. Honestly, it is very time consuming. And to really feel comfortable with a GP and handing over $50,000, $100,000. So how do you approach that, right? Well, so there's different ways. You could do it yourself. You could do the research yourself, start attending networking groups, start attending conferences, start meeting people, start talking to people. One thing you'll find in this space is that people are not going to say negative. For the most part, people don't speak negatively about other people in public forums. So it's just not something that typically happens in a public forum. So if you want to find out things that didn't go well with a particular sponsor, you're going to have to go through the effort of finding those conversations, having those conversations offline. So that sounds like a lot of work, right? And it is, to be honest. But there are options. Like, so for example, my firm, Lux Capital, we are like the travel agent in this situation. We vet operators and deals. That's what I spend most of my time doing, is meeting operators, going to conferences. I host a podcast, so I talk to a lot of people and constantly looking for the word on the street about, what's going well, what's not, and just thinking very deeply about different deals, asset classes, operators, markets. And so I'm bringing the best deals to my group, and what I consider to be the best deals. And then we're investing as a group, which means that we get an even greater portion of the equity, and that's how I get paid. So that's another option, is you can find somebody that you trust who's vetting deals.
Interesting. And I was going to say too that, I have people ask me about due diligence items on any number of asset classes, and it really is it's a place where I encourage people to put on their skepticism hat, for lack of a better way to put it, and to find out the information that they need to make themselves comfortable, because it can be a process that's a little bit difficult and a little bit maybe outside your comfort zone or your normal operation. So if you feel a little pushed by having to do the due diligence, you might be in the exact right place. Okay, next question. I know an LP can put IRA money into a syndicated deal. Can a GP put their own IRA money into a deal, or is that not allowed? So I'll go ahead and field that one. Generally speaking, the IRS has a prohibition about an IRA investing in an entity that is owned or controlled by a disqualified person. And certainly the account holder, as well as some close family members, are considered to be disqualified persons. So I would say that generally speaking, if you're the GP on an investment, you would not be able to, or excuse me, on a project, you would not be able to have your IRA money invest in it. I'm also going to say that I'm not an attorney, not giving a legal opinion, and I've seen people challenge some of the IRS rules in ways that are pretty creative. So, I mean, at the end of the day, I would say you might want to ask an attorney, but on a general basis, the IRS is going to look on a transaction, and so would we as a custodian look on a transaction where the account holder is listed as the GP and the IRA is looking to invest in that. We would see that on its face as a prohibited transaction. Amongst other things, you would be something that the IRS calls providing services for your IRA. So again, in the 30,000 foot level, no, you wouldn't be able to do that. Are there exceptions? Yes, there are always exceptions. In the capital stack, who represents Class A senior debt versus Class B mezzanine or equity positions?
Yes, so good question. So usually there's a senior mortgage, a main mortgage, where that's the main bank that is the lender. And there's different ways to form mezzanine debt, right? So the senior debt is going to come first. Then next is going to be the mezzanine debt, if there is mezzanine debt. That could be in the form of private lenders. So sometimes GPs will take on a supplemental loan from either another bank, but it could also be from private lenders. So it's just that you're going to have to look at each deal and determine that on a deal by deal basis.
Okay. Okay. For an investment home, can you use money from a self-directed IRA for a down payment and use personal loan for the rest? Generally speaking, no. An IRA can actually take out debt to purchase an investment home or an investment piece of real estate, but it actually can't use the IRA holder's personal assets as collateral, which is, I believe, what you're alluding to in terms of the IRA holder taking out the loan. Anytime an IRA uses debt to secure a loan for an asset that it wants to purchase to extend its buying power, it does have to be non-recourse to the disqualified persons. So all of the account holder and certain family members can't pledge their personal assets as collateral for the loan. So the IRA can take out a loan, but usually it's based solely on the merits of the subject property itself. And again, there are some variations on that, but generally speaking, that's the way the IRS looks at it. Are the fees that the GPs receive, do they get subtracted from the expected returns that the LPs are supposed to receive?
Great question. The fees are always taken out before the returns. So you want to double check this with your sponsor, whoever's presenting the deal to you. But for me, for example, whenever I'm projecting returns, that's after all fees. So net to investors, we're projecting, 16 to 20% average annual return usually.
Okay. The next one is a good question too. So what is a good way to diversify investments in this space that we're talking about, this kind of syndication space?
Oh yeah, great question. And it's one of my favorite questions and one of the reasons why I do what I do. I'm a passive investor first, and I view my role as bringing a variety of deals to my investors across different asset classes, geographies, and operators. So a good way to diversify is to first of all look at different asset classes. We talked about multifamily syndications because that's something that a lot of people can relate to, but there's actually other types of investments, asset classes that you can make. For example, mobile home parks, self-storage, senior living, industrial. There's several different asset classes which I consider to be recession resilient. Also hotels are an asset class, office is an asset class, retail is an asset class. So, I have my preferences and asset classes which I consider to be recession resilient, and at the same time, things are always changing. So that is, a constant something I'm constantly evaluating, and that's one way. So different asset classes. Another way is different sponsors. So, in general, we don't want to put all of our eggs in one basket. So that's why I like to work with different sponsors. And as much as I love one sponsor, I don't necessarily want all of my capital to be invested with one sponsor. So diversifying across sponsors. And then I also like to diversify across geographies, right? Because, I don't necessarily want my entire life savings and capital to be wrapped up in one market. I want to be in different markets because you just don't necessarily know how that, like, what if one market tanks, right? Obviously. So, of course, I want to make sure that I like all of the markets. I want to make sure that I like all of the sponsors and that I like all of the asset classes and deals. So, it's not to say you should blindly diversify, but those are some ways.
So it's another example of where the vocabulary doesn't really give you always the whole answer. There's all kinds of diversification tools or vectors to look at. So that's interesting. So there's somebody asking a couple of quick questions about your operation, Suja. Do you have any current offerings?
Yes, I do have some offerings that are available to accredited investors.
Okay.
And that I could share. When it comes to, there's SEC rules that's, we would have to have a conversation, and then I can share more of my deals with you.
Okay. So this is one of those things where it would be best for them to contact you through the website or through your email or phone number to just start the process and learn a little bit more about whether there's a match there.
Yeah, exactly. Yeah. So please feel free, if you are curious about what offerings we have, please reach out to me. You can shoot me a text, you can shoot me an email, you can sign up for my newsletter on the website, whatever works best for you.
Okay. Do you recommend entering into it? And I'm going to take this question and maybe one more, but I want to be responsible with everybody's time here. I know that we're after our hour. Suja, can you hang out for one or two more?
Yeah.
Okay. Do you recommend entering into an LP position that is required to meet future operating capital calls versus being limited to your initial LP investment?
Oh, I'm sorry. Can you just repeat that one more time, Clay?
Yeah, I think that the questioner is asking, is it better to make an investment where there's an expected capital call, or there might be a capital call later, versus one that is just your initial investment and that's it?
Yeah. So, okay, this is the deal with the capital calls. Those are, and in my opinion, should be considered a worst case scenario. You don't want to plan for a capital call. Okay, capital calls are only if, things really go awry and the deal's about to die, and so investors need to put in more money to float the deal or lose all their capital. So usually there is always there is generally typically going to be the chance for a capital call. However, you want to look at your sponsor and see, well, what would they do if something bad happened, something very concerning happened for the deal. So if your sponsor has a good amount of financial backing, if they have like a strong net worth, then they can usually loan money to the project rather than do a capital call and ask investors to put more money in. So that's where you want to look at the strength of your sponsor. Do they have deep pockets? Because I've definitely seen of deals where the sponsor does not have deep pockets, and then they do have to do a capital call. So it's always a possibility, but there's ways to mitigate against that. One, looking at the strength of your sponsor. Do they talk about what's going to happen? Usually a sponsor will say, well, we will make a GP loan, rather than do a capital call, because we don't want to do that. So have that conversation with your sponsor.
Got it. Okay, last one, and this kind of dovetails into what you were just talking about. And if you do have other questions, you can certainly contact either of us. You'll have our contact information on the screen. If you type it in here and it comes in late and we haven't answered it, I'll try to get an answer back to you, of course. But it looks like we're at the end of the question, so this is a good way to wind up. And what they were talking about, the next question is, what's an example of a GP or a project failure or something going awry? What does that actually look like?
Yeah, I mean, I think that's a great question. And obviously I can't share specifics, but I'll tell you an example in general terms of what happened in this one, catastrophic failure that I mean, I wasn't part of, but I know people who were a part of it. So they were building apartment buildings, Class A apartment buildings in California and in a very desirable downtown area. This was prior to COVID, and this is where you want to look out. I mean, and this is a really important question, so I'm going to take a little bit of time to answer it. So this is where you want to look at what's promised to investors. So in this case, the investors were promised about a 25% return from day one. And this is a new construction project. So during the life during the construction period, investors were getting 20, 23 or 25% return. That should have been a red flag to any sort of sophisticated investor. So because there's no money coming in during construction, obviously you're just spending money trying to build a property, there's no rents coming in. So how could you possibly pay investors 23, 25% from day one? Well, the reason that happened was because the sponsor basically needed, they were probably close to 95, 99% leveraged. How we talk about we want to be 70%, I said 75, 65% loan to value. Well, in this case, the investors were actually providing the debt for construction. They were in, like, let's say a mezzanine debt position. And so he had to pay them through the life of the construction period. So then COVID hit, okay, and things were going pretty well. And there's like a lot of other details that I could share, but things were going pretty well. And if everything went exactly according to plan, then probably it would have worked out. But COVID hit, and people didn't want to live in high-rise apartments in downtown area anymore, and the project completely fell apart. And then investors were asked to do a capital call. And so I actually don't know the ending of that story because it's still playing out. But what I can say is that, you can avoid a capital call if you actually are really realistic about what it is you're promising. Of course, everyone likes the idea of like, oh, well, it's like, I'm first in the capital stack and I'm getting a 23-25% return. But is that a realistic scenario? And how protected are you as an investor?
Interesting. Well, Suja, I want to thank you for spending some time with us today. I appreciate you bringing your story and your expertise and helping us with the vocabulary. I know that that's always something that is confusing for folks. So thank you very much for your time today. Appreciate it.
Yeah, absolutely. Thank you so much, Clay. It's really great to be here with all of you.
Yeah, and thanks everybody for joining us, for spending some time with us, and hopefully this is helpful in terms of you developing your investment strategy or understanding how you're going to be thinking about deploying your money in the future. So, and Suja and I would be happy to be a resource for you going into the future. So please do take down our contact information and let us know if we can be of help in that way. And for now, I'm just going to sign off and say thanks a lot for joining us. Have a great rest of the day, and we'll see you on the next one.
Bye, everybody.